Good afternoon, everyone. Welcome to Finlight's roundtable session to discuss how to handle conflicting intergenerational ESG views amongst family members. I'm Juliet Carter, the CMO at Finlight. Today, we are joined by four excellent panelists across the ESG, technology, and family office space. We will start by the panelists introducing themselves. So let's start first with JB, Nisa, Ben, and then Tifan.
All right, good afternoon, everybody. I'm JB Tankare, the founder of Finlight. Before launching Finlight, I was myself the head of a family office between Paris and London, with a mandate of having a low carbon portfolio, hence very much into the ESG world. And that's why, joining forces with the likes of Nita, Ben, and Tiffany, working together to see how technology can simplify that for everybody. That's it for me.
Perfect. I'm Nisa Jetta. I am currently a director on a United Nations intergovernmental organization that works to bind countries into the Sustainable Development Goals. I have in the past worked in investment management as well as headed up an impact department that was co-invested with two large family offices with a focus on Africa. So very excited to be here. Thank you.
Hello, everybody. My name is Benjamin Webster. I'm with a company called Owl Analytics. We are an ESG data and analytics company. We've been around for 9+ years, and we work with asset managers, insurance companies, asset owners, and hedge funds and other institutional investors throughout the world. And what we do is we try to be a comprehensive provider for all of their ESG data needs. And I'm really happy to be here and excited to talk to all of you.
Perfect. I'm Tiffany Saltini. I'm the CEO and the co-founder at Neuroprofiler. I created Neuroprofiler during my PhD in behavioral finance when I was working in private banking. And the objective of Neuroprofiler is to help financial institutions assess the investment preferences of their clients, including ESG preferences, through behavioral finance and gamification.
Thank you, everyone, for the lovely introductions. So before we begin, I'd like to cover a few administrative points. The webinar is being recorded and all the attendees are in listen-only mode. For the content of the webinar, Chatham House rules do apply. If you have any questions for the panelists, you can submit them through the Q&A functionality at the bottom of the Zoom panel, and we will respond to them at the end of the session. We will also conduct 4 poll questions throughout the session, and we'd very much appreciate your participation. The format of the webinar is a roundtable discussion where we will gauge different opinions from our panelists, so we will keep it highly interactive. We first explore why ESG is important and what is the intergenerational ESG gap. We will then examine some of the challenges for families with a main emphasis on the conflicting views from different generations. And lastly, but very importantly, the role of technology in that. So let's begin first with the question for Nisa. Have post-pandemic trends led to a significant increase in impact RFPs and a surge in ESG due diligence?
Thanks. I think for a lot of you, that's a mouthful. So I think that first, let's start with the fact that the pandemic really effectively polarized a lot of the have and the have-nots. So generally, a lot of institutional wealth holders decided to curate their thesis around impact. And what that means is that they often simply wanted to make both a financial and social return. RFPs, effectively large family offices and clients, were eventually going to their investment bankers and then asking them for impact products that they could invest into, as well as when we talk about a surge in ESG DD, it's environmental, social, and governance due diligence. So not only was it the regulatory and compliance angles on whether we were making the investment, it was then, is the investment ESG ready? Have we pegged the E and the S and the G diligence risks, and are they then comfortable to assess it? So I would say never before have we had such an influx in a product like this.
Thank you for that. There's been a lot of talk about impact washing. It's a real hot topic. So what exactly is impact washing, and What are the regulatory and social risks of non-compliance?
Again, a very, very huge topic that everyone loves to discuss, and I'm sure my dear panelists would also love to comment on this. But I think that just leading on to point one, the fact that there's a lot of institutional next-gen millennial family offices really now coming into their wealth and would love to see an impact focus and thesis. Alongside this, you see institutional managers across the board really trying to have a bit of that impact thesis within their investment vehicles. And generally, impact is measured by an array of, I call it alphabet soup, but largely the UN development goals. And so we see a lot of managers and product developers really trying to say that this is our impact, but there's no real way to really monitor and benchmark that. We see, due to the fact that the Biden administration really has kind of pushed the green financing, there are now a lot of regulatory risks by the SEC, FINRA, and we see it now even within Financial Conduct Authority. So not only do we have regulatory risks on the financial service side, we also have the social risks. And you see people like Larry Fink saying climate risk is actually an investment risk, and that we do need to kind of do the upfront due diligence and hedge for that because it does outperform the market. But I'll leave it open. I'm sure my panelists would also love to discuss a topic like that. But thank you for the question.
Ben and JB, would love to hear your thoughts on that.
So before finding Finlight, as I said, I was the CIO of a single family office and with a low carbon mandate. And it's very difficult to find a founder product that is truly ESG oriented. You would have a lot of asset managers, providers say, oh, we ESG, because you just have an analyst saying whether on the E, on the S, on the G, the such and such product will do well. But you would see that effectively that ESG rating will not have any impact at all whatsoever on the portfolio manager's decisions. So you were served, and you've been served and keep being served a lot of ESG hyping stuff just because you've got an ESG analyst, but whose output will not change the decision-making process. So that's the big issue there, where you have to dig further and it makes the whole research of products more complicated. Another issue which I found, and I think what happened in Western Canada and Northwestern US should evident that is what this HSBC paper written by Mark Campanelli, among others, talking about stranded assets. And to really make sure, just the stranded assets idea is, okay, today we value assets at that price, but would climate change occur, this asset will worth nothing. And I think, when we see trees in Canada, how these villages being wiped out of the map, that's clearly an evidence of these stranded asset risks. And I really think we will move away from greenwashing the day risk management, these companies, as well as portfolio managers, would just use ESG and impact environment and society as the first criteria of selecting investments before doing any other due diligence. And until that is really done, implemented throughout all asset management companies, we face a massive ESG greenwashing risks.
Ben, would you like to comment on that as well?
Yeah, there's a lot to unpack in what both of them said. Let me start with what Nissa said about an increase in ESG RFPs. That's 100% true. We're an ESG vendor. We get a lot of those RFPs, and they have greatly increased. What I question, and this is I don't know the answer myself to this. Is there an increase in RFPs because of the polarization of society, or is there an increase of RFPs because regulators and non-governmental entities like the UN are pushing that agenda, right? Maybe for the right reasons. But if you do have regulations like the SFDR, the EU taxonomy, TSTD, sorry if I'm saying that wrong, that is going to require companies or funds that want to be called sustainable to have certain disclosures, without a doubt, asset managers are going to ask for data on that, whether there's polarization in society or not, right? I think that personally, the prior to the pandemic. I know this from being, at least from my personal reception of RFPs. I was getting just as much right prior to the pandemic as I am now. I think the pandemic just delayed everything for 6 or 8 months, to be blunt. Now, I'm not an ESG data. I'm not every ESG data provider. I'm only my ESG data provider, right? My company. So that I obviously have. It's a small selection of data that I'm looking at the RFPs before and after. Now, as far as what JB said in regards to how do I say it? ESG strategies, right? And how hard is it to find an ESG company that has a good ESG strategy that is actually making a real positive impact on the world? Now, I think there's a lot of shades of gray there, right? ESG is an inherently subjective subject. It's highly tied to ethics and values, and everybody's got different ethics and values, right? You don't have the same ethics and values as your parents even, right? And so I question, is it the job of a company to have a positive impact on the world? I don't know if that's true. I do think it's a job of a company not to have negative impacts on the world. They're not the same thing, right? So, a job of a company actually is to generate a profit and grow, right? And to build products that people want to use and consume. Now, the question is, are they doing it in a way that pollutes the environment? So let's say I make a widget or hurts society through discrimination or whatever. If I make a widget and it has no effect on the environment, right? And let's just say that widget's job is just to make people happy all day long, right? I'm not hurting the environment. Let's say I'm selling it at a certain price that's widely affordable everywhere. Most people can afford it. Am I doing anything? I'm not necessarily having a positive impact, right? Maybe I'm making people happy is a positive impact. But let's just say it's a widget that, instead of making people happy, it's a widget that makes people's apartments clean or houses clean, right? I don't know if that's necessarily a bad thing. It's probably a really good thing without having a positive impact on society. But you also have to remember, an average company has a positive impact on society, whether it's helping the environment or not. It's creating jobs. It's oftentimes providing healthcare. So I don't want to throw the baby out with the bathwater, right? The system is actually a pretty good system, and companies are now engaging in disclosing about their effects on the world. Pre-regulations, they were doing this, right? You look back as much as 10 years ago, you could see them disclosing carbon emissions, disclosing on other social issues in their reports. Now, whether they're lying or not is a different issue, but I don't know if regulation is going to solve that either. Yes, greenwashing is an issue, but there is a lot of hard data that they are disclosing, and they were doing this on their own before regulations. Much like the minimum wage laws back in the day, a lot of private companies were already having wages higher than minimum wage before the minimum wage laws came to pass. So without a doubt, it's a really good thing that companies are trying to be more responsible. Asset managers, investors are trying to be more responsible. I don't necessarily think, though, that we need to be draconian and change the whole purpose of what a company is. I think a company does have a responsibility not to harm other people's property and not to harm the world, but it is not their responsibility to make the world a better place. Though it's a great bonus if they do. Maybe they're developing technologies that make the world a better place, but that's part of their business. That's how their business makes a profit. That's how they supply jobs, right? And so I think we're all good-hearted people, and I think we all want the world a better place, and we want companies to do better. I just disagree that it's their job to make the world a better place.
If I may add, we're not talking about making, well, if you want to satisfy a customer, if you want to return a customer, I mean, you've got a moral responsibility. I mean, we're not here to talk about philosophy, but there's one thing we would agree is economics 101. If you maximize the output while minimizing the input, then you're being responsible. That's the first step. That's we fully agreed on that. Now, how do you look after the entire product life cycle? It's even better, but also responsibility towards your customers as well. And that's long-term engagement with them. But then I don't want to get philosophical because I've got a European view and it was not a European view, a French view. And, but you know, I don't want to pollute that, but I mean, economics 101 is to maximize output with a minimum of input.
I think it's a very good segment into our first poll question. Does industry practice measure impact in ESG the same way? It'd be great if you could all participate. Okay, let's show the results. Nisa, I think it'd be interesting for you to comment on that.
Yeah, so I think there's a lot of good stuff that actually just came out of this discussion. So I actually do resonate with what both JB and Ben did say, is that for me, I operated in private equity, private markets. And what we did, and we looked at ESG almost as a negative screening process, as in first we would take something called the IFC performance standards, you know, generally used by the World Bank and various development finance institutions. And we would just do a screening, just like you would do a screening for money laundering and compliance. So similar to what Ben's saying is first do no harm. We're not saying let's, like, our job as a company, as an entity is to make it a better place. And if that generally was just more of a commercial standpoint, that was an obligation by our co-investors. So ESG was being more or less the negative screening. When we look at impact, and again, it is such a polarized field, but impact is generally, what impact are you making simply? And that is measured so specifically, and people then go back into what's impact washing, because if you use a random Gin matrix on a healthcare consumer fund, you could be impact washing because you could just do a tick the box exercise. So I think that generally there are specific rubrics on negative screening for ESG, and impact is usually your theory of change, or Ben would say like making the place a better place. And that's just kind of how I see it and how I've operated in the field for about 5 or 6 years. But again, would defer to the group if anyone else had to comment. So I would say they are actually quite different in private markets in my stance.
Thank you, Nisa. You mentioned this about how difficult and challenging it can be to measure and analyze sustainability and how polarizing it is. Benjamin, this is a question for you. What do you believe has been the most significant impediment that families face when analyzing the sustainability or impact of their investments?
Yeah, it's very simple. It's lack of data, right? A family or any investor may be invested in the public markets, may be invested in the private markets, across various asset classes. And how do you know you're not doing harm or making a positive impact without data to back up your decisions, right? And interestingly enough, you also may not have the data to know that you may be doing good in a certain way. You say you invest in a company that's doing certain things that are good, and you're doing it for an impact reason. Maybe they produce a technology that's making the world better by lowering pollution or emissions or what have you, but maybe they have bad hiring practices, not a diverse workforce. And so you may also, with making a positive impact in one way, but you are actually making a negative impact in another, right? So without the data to really know what's happening with your decisions and the types of companies you're supporting and their business practices and their positive and negative impacts on the world, you are somewhat operating in a vacuum, right? Or with a very narrow focus on the type of data you can get a hold of, right? And we find that time and time again, you may have an ESG or a sustainable investment fund, which actually, if you look at the ESG metrics of it, doesn't score very well. They may be doing very well on certain things, but very bad on others. So just because it's got a sustainability or social responsibility or a similar name in their product name, similar words in their product name, doesn't mean that you are actually making a net positive impact on the world or investing in a net responsible investment vehicle or investment. And so I think part of that is ESG data and impact data is very expensive, right? And so it's also very hard to work with. It's not necessarily normalized in all cases. Oftentimes it may be missing, because that's one of the things that this regulation is going to be helping, is that companies are going to be disclosing more and disclosing more uniformly with regularized standards. So that some of those problems will be solved, but it's still going to be a very it's not necessarily a data set that's everywhere. It's not it's very expensive, and you have to get that data into the systems that investors use and report on, right? And report with to their investors. So they're looking at the investment manager or portfolio manager is looking at the same data that their client is looking at in the same report. They can talk one-to-one to each other on how their investments have made impact, where they've done well, where they've done bad. And that's just not the case right now. It's very much the purview of portfolio managers managing billions of dollars, and that data very seldom seeps to actually the people who are spending the money.
Thank you very much for your insights on that. Tifan, would you like to comment?
For me, the idea also is that for families, of course, the idea is to be able to have access to this data. But another question is also, do they want also to have access to this data and to have this kind of analysis? Because for me, a big issue with sustainable finance, and this is the topic of this webinar, is this intergenerational difference. And for more senior clients who are part of these family offices, the true question is why doing this analysis? Why sustainable finance? And of course, it's obvious for us because this is why we participate to this webinar, but it's not so obvious for some members of this family. So I think that's still a main challenge, awareness about sustainable finance, especially again for more senior clients. Today, 80% of millennials want to have an impact, but only 30% of people above 70. So that's also a challenge.
Great, thank you. So Benjamin, I have another question for you. Do family offices tend to invest more responsibly than the average investor?
That's a great question. And I think a lot of family offices like to think that they do. It may be true for at least private assets they invest in, but I can't name names here, but we work very closely with a technology company that works with thousands of family offices, right? And they are in the middle of a research project and looking at does the average family office invest in ESG in investments that have a better ESG profile? And they're finding out that it's just not true. Their investments are typically right in line with the market, right? And even if they may be invested in socially responsible funds with a name of that type, it kind of goes back to the lack of data, right? I know certain viewers think that there is a widespread use of data. There just is not, unless you are an investment fund or a investor that can afford that data, right? Yes, it's available if you can afford it, but most can't. The average mom and pop investor don't have access to it. The average wealth manager or investment advisor doesn't have access to it, and that's the larger part of the market, the vast part of the market. Asset management companies, institutional investors do, but even then it's still not very widespread because I work with many large global banks with numerous investment teams, right? You can work with a bank with 30 teams, each managing multiple billions of dollars, and only a couple teams have access to that data because they're either not interested in it, or they can't afford it, or they haven't gotten to it yet because they're just figuring out how to make a good risk-adjusted return, right? And they don't necessarily think ESG is going to lead to that isn't going to be valuable to that goal of a better risk-adjusted return, wrongly or rightly. So yes, there is a lot more data than there used to be, a lot of sectoral data, but just data rate across the board, across all sectors. But whether or not people can get their hands on it affordably and easily, and in a turnkey fashion that makes it easy to disseminate it to their clients, that is so far from being true. And our goal is to help make that true. So, I do think family offices, more so than others, do want to make a positive impact. And we're hoping that with more availability of data to them at a more affordable price, that they're going to be able to start doing a better job at that.
Thank you. Nisa, would you like to comment?
Yeah, no, I think actually it's just such a general question to say, like, do family offices? I think first looking at family offices, and what Ben said is that a family office can deploy catalytic strategic capital very quickly, right? So they do have the ability to move capital very quickly, and they can do direct investments, right? So of course they have the ability, if they wanted to make a lot of impact, to do that. But whether they do in practice is neither here nor there. So it just goes back to the investment thesis. And I do think that a lot of impact capital is coming out of family offices just due to the fact that the next generation change in wealth from young families inheriting their wealth and being able to then deploy it. But I agree that I don't think we could make such a generalist statement that family offices are more responsible just because they're more strategic and they have different vehicle base.
So the second poll question is going to come up on your screen now. Which is the primary means that you currently implement your ethics or impact investment goals? Okay, we're ready to show the results. Ben, what do you think of the outcome of these results?
It actually supports kind of how I was looking at it. The vast majority of the way people are accessing responsible investments is just looking at a name in a fund and in a mutual fund ETF without the data to back it up, unfortunately. Investment vehicles have to be more empowered with data, and I think that's going to help investors make a better decision to look at trade-offs between risk and return and social responsibility. If there are trade-offs, in some cases there will be trade-offs. In other cases there won't. ESG will enhance risk and return. It's not a uniform thing. ESG data is like any other tool, and you can use it wisely or unwisely to make decisions about how you want to build your portfolio and how you want to impact the world, or how you want to generate risk-adjusted returns. So data, again, will empower investors to look at it more holistically, not just have to rely on there being a name in a fund.
So we've already touched a little bit upon data, but we want to really look at the role of technology. And it does play an important role in minimizing the intergenerational gap and improving transparency. Tifan, which tools could be used to facilitate intergenerational discussion?
Yeah, so we saw with Ben that the access to the data is a challenge. The price of this access is a challenge, but the second challenge is also the willingness of the family to invest in sustainable products. And again, there is a real generation gap, and that's why the discussion in the family is very important. So I will just share a personal example. Last Christmas, I discussed with my grandfather about the launch of our new model dedicated to sustainable finance. And actually, I faced two challenges. The first one was just a definition of sustainable finance. For him, it was something completely new. So I tried to explain the idea, and well, I spent time. It was really not obvious. And the second challenge was just why? So why should I invest in sustainable finance? When I want to invest, I want to make profit. And when I want to do good, I give my money to charities. So what's the point? And it was so hard to explain that now, today it's you can be very, very profitable and have a very positive impact. But it was not really convinced. So I just asked him to play our ESG profiler, this little investment game, and it worked. So at the end of this games, it's an external tool. It was much easier to understand the concept of sustainable finance, to understand his own values, because of course we have values, we want to have positive impacts, and also to understand that today you can again have profitability and positive impacts. So it's not necessary with an ESG profiler, but just the idea to use an external tool, more neutral. I think it's a very good way to foster this intergenerational discussion.
Thank you, Tifan. Ben, what do you think about that? The tools that can help facilitate intergenerational discussions. What are your thoughts?
So yeah, no, I think that's an extremely valuable tool. As I mentioned earlier in the conversation, everybody has a different view of the world, has different ethics and different values. I think a tool like that can not only explain what sustainable finance is, but it also could isolate for an investor, whether it's an individual or a group, or a fund or what have you, what sustainable investment goals are important to them and what others aren't, right? And so it allow investors to have a personal expression of their values, while hopefully at the same time investing in a great investment product that could generate a great risk-adjusted return. So I think, to be blunt, I think it's a huge missing piece. I think it's a piece of the equation that if you can get that cost effectively in the hands of financial technology throughout the world, that I think that would lead to a result that would lead to an explosion of everyday investors being able to actually put their money to work in a meaningful way that's not only meaningful to the world, but meaningful to them personally.
Okay, we're all talking about data, cost of data, and indeed the big challenge is how to make sense of this data. I mean, as Ben and Tifan, illustrated, and Nisa illustrated, you receive a lot of data, which is tough to retrieve, expensive to retrieve. I know some of the attendees disagree with that, the cost of accessing such data. But the most important is, okay, what do you do next with it? Especially back to reconciling different family values. How do you use that data to cement that agreement among family members of what family wealth is meant to achieve? And I think this is something the Rockefeller family did very well by having a clear set of values to which all members will have to adhere, and use the right metrics to ensure the family adheres to that value to keep the wealth going generations after generations. So yeah, that's why technology is unavoidable.
Great, thank you. So there's another poll question that's going to come up. Poll question 3. What is your main challenge regarding sustainable finance? Great. Let's look at the results. Interesting.
Yeah.
Tifan, do you wanna comment?
Yeah, no, it's very interesting, and it's definitely the sense of the regulation today, because so far the regulation has focused a lot on financial products, on how to assess the ESG impacts of financial products, and finally the second part of the issue, so how to understand the expectations of clients, how to match these expectations with products, how to train advisors to be able to cope with this ESG preferences and these ESG products. Well, my feeling is that this will be the next challenge, because now most of financial institutions are focusing on this new regulation, but the next part of the regulation coming next year will be also quite challenging.
Thank you, Tifan. JB, given your experience in the family office space, how do you think families tend to agree to disagree on ESG and have a policy in place?
Basically, when I was having this, reading this family, and I was part of course for family offices trying to network with each other to resolve that. So the first element, which I found back to what Tiffany says, one of the panelists James said earlier, is to reassure the older generation there is no dichotomy, no opposition on making profit and responding to ESG value. That's part of the education. That's part of making sense of the data is really relevant. And there was an article in the FT earlier this week that mentioned that ESG used to overperform other strategies recently. When it lasts, it's a different discussions, but back to economics 101 of maximizing output with a minimum input. But then that's the education here. And therefore, what you have to do between a member of the family who doesn't want to give up a certain lifestyle or are fearful that going a certain way would mean giving up a certain lifestyle, and younger generation who wants to avoid the reputation risk. The best way actually to get them agreed together is, as I said earlier, on agreeing on values. Agreeing on values and using that the way of cementing a sort of a family social pact together. That's very important. Now, when you have different situations where there's a disagreement in value, which creates a governance issue, then the best way of agreeing to disagree is to run assets separately. And that everybody is prepared to live up to the reputation risks they're going to face by getting involved in things that could be politically looked upon, or accepting a different yield level to keep on passing wealth generation onto the next generation. That's how it would happen.
Thank you, GB. And this is another question for you. As they have multiple and complex assets, how thoroughly do they apply ESG standards across all assets?
Well, that's very difficult because, and of course, it's something we're looking to solve with Finlight by consolidating assets together. So basically, and it's back to what Ben and Tiffany were saying earlier on with NISA, is how you're able to map the asset that you have with the ESG behavior that you have, and whether this is back to the ESG rating family, you can have this holistic approach as whether the overall asset classes works. Now, if you look at infrastructure investments, many of them tends to be now energy efficiency. These are private businesses. How do they disclose? How do you manage to get this data to rate them? It's an issue. Same with talking about venture capital, technology. So technology on many ways could be rated very well on ESG, but we know technology now, especially cloud computing, have a massive impact, adverse impact. How did that offset? And this is where it's getting a bit difficult, and it's where the person that need to have an enhanced due diligence and be able to monitor that more accurately through ongoing contact with the different representative of its investments. But the basic there, first of all, is to be able to at least know where you are, where you stand, and what kind of economic risks, social risk, governance risk you potentially exposed based on the asset mixes you have in your portfolio. And you need to have that view, otherwise you're not able to take the dialogue forward.
Thank you. I'd love to hear Tiffany and Ben, if you would like to share your thoughts on that.
Yeah, perhaps to complete the point, indeed. So before, a couple of years ago, this matching between products, even complex products, and preferences was quite simple because we had one dimension, risk, and that's it. And now this is becoming very, very complex because first, with the European regulation, we had to add the notion of financial knowledge. So first challenge. And now third challenge, ESG. And of course, we don't have one single ESG score and one single ESG score for products. It's much, much more complex. So yes, the real challenge today is to be able to have this multi-dimensional matching. And so far, most financial institutions, including, of course, family offices, are not equipped. And even with a very, very good advisor, this will become a real challenge because we don't have an algorithm in our brain, and to be able to to match all these combinations, we will need tools for sure.
Any other thoughts on that, or should we go on to our last poll question? When it comes to ESG, which one is the predominant concern? Environmental, social, governance, or all of the above? There we go. Look at that. All of the above.
That's interesting. Well, that makes sense if you think about it, because if you're careful about the environment, probably you have relevant social policies as well. And to have relevant policies, you mean you have a certain level of transparency, which plays in favor of good governance.
Just also to complete, it's also very interesting from a generational point of view again, because and at least based on our data, we can see that more senior clients, investors, are more interested in social impacts, while younger clients are more interested in environmental impacts. And we can see here also that we can have a gap between the existing offer. Now it's a bit more focused on environment, and the expectations of the more senior clients in terms of investments.
So it's now time for the Q&A session. If you haven't already, please feel free to send your questions in the chat. We'd really love to see them. We already had loads that came through, but if you have any other ones, please let us know. And if we don't get around to it, we will send you a message or an email or contact you with a response. So the first one is directed to you, JB. Is ESG investing a fashion or a secular shift to yield extra return?
Well, I would say, to me, there's a secular shift. I mean, as we say, the reason why you've got an intergenerational issue around ESG is really the evidence that there's a secular shift there. Is that a way of extracting additional yield? I would think so, because if a business is well managed, it's got good risk management, so future liabilities, everything are better managed, and therefore should be able to outperform peers who do not necessarily pay attention to that. But if we're talking about a secular shift, then we should agree that being ESG responsible will be the way of generating returns, because non-ESG responsible companies will face credit challenges, and that'll make it extremely hard for them to support the business in a profitable fashion.
Anybody else want to comment on that?
I don't think it's either a kind of a fad or a secular shift to get better risk-adjusted returns. It's here for just a lot of different reasons, right? People have different goals in ESG investing, but I noticed James said in the comment, one of the viewers said in the comments that profits are impacted by ESG. He's 100% right. Whether or not an investor is investing in ESG for that reason is a different story, right? So it's incontrovertible that investments have an effect on the world in some way, shape, or form or another. We're starting to realize that there are unintended consequences. I think everyone wants to figure out how, unintended good consequences, unintended bad consequences, and it's like the genie's out of the bottle per se, right? There's our whole social fabric, from regulators down to the small individual investor, is thinking about these things in some way, shape, or form now. And now the question is how do we marry the two? How do we in all facets of our societies, from government to companies to other institutions that make up our social fabric, how do we deal with this issue? How does it affect that we make decisions? Again, it's not going everywhere. It's anywhere. It's a complicated thing, but it's good. It's good that we're talking about these things, that we're not sweeping it under the rug. And it's okay to debate. It's okay to disagree, but it means we're engaging, and it means we're all applying our minds and trying to figure out solutions. Which that's just an amazing thing, and amazing to be a part of it, and I think an amazing thing for the world.
Thank you, Ben. Nisa, there's 3 questions in one that are directed to you. Is there impact due diligence? What is a theory of change, and why does this matter to investors?
Okay, lots of technical terms. So again, right, having operated in private equity, like generally a theory of change is, had I not made the investment, what would have come? How many women are you going to hire on a C-suite level board? How many jobs? The pinch points of what is the theory of change. Impact due diligence, I mean, I would say that I think when I view, and I also would defer to the group here, when I think about impact, I think about it as the forward-looking lens on what I would be doing had there not been capital that was put there. And I would say the due diligence part of the screening on environmental, social, and governance. What we're seeing now is due to the influx, as I mentioned, of impact washing, that there is just this curated version of what you are doing needs to match your own personal metrics. So similar to what Ben and JB said, that their client is looking for something, where does the data hit that? And then where do we go from really achieving the impact going forward? And what does that mean for investors? Okay, so I answered all three. Hopefully that's good.
Thank you very much. Anyone else want to comment on that in the panel? JB, for example, any thoughts?
No, I mean, I completely agree with what Nisa said, and fully agreed on that. And yes, as Ben said, now we're talking about it. Are we talking about it, early in our consider fund discussions? But yes, now this is clearly something that keeps everybody focused. Yeah.
Great, thank you. I think this one, Tifan, is directed at you. If not, other viewpoints on the panel would be relevant. Do you already see generational differences regarding the appetite for sustainable finance?
I'd say there's a great opposition between the boomer and the millennial, which I find a bit unfair. Clearly, depending on generation, not everybody has the same areas of concern. I mean, it's a Gen X as well, which I'm part of. I'm also very concerned about that. So is this sorry, for me, the one is a bit tough to pronounce, intergenerational difference here to stay? Don't think so.
Tifan, any thoughts on that?
Well, at least only based on our data, because now we are working with private banks, retail banks, or with different kind of end clients. And yes, we can see that there's a stronger appetite of younger clients, if we don't want to use the terms of millennials, for sustainable finance. And yeah, based on numbers, as I mentioned, through surveys, we can see that 80% of millennials want to have an impact. They are ready to go to another bank or to another financial institutions if they can't have an impact with their investments. While with more senior clients, their preference will be more around 40 or so 30%. So there is a difference, but the true question is to understand if it's really a question of convictions or a question of this cliche that basically, if you want to have an impact, you need to sacrifice profitability. Right. And that this message is quite clear for young clients and not so obvious for more senior clients.
Thank you. I think this one could be good for Ben, and there's two questions in one. So what is the trade-off between risk, return, and sustainable investment goals? And is there a trade-off?
Not to be trite, it just depends on the situation, right? It depends on the product. It depends on what the goals are. It depends on how in some cases, just how well the investment manager chooses the securities they invest in and the weight of those investments in the portfolio, right? Let's stretch a point to make a point, right? You could have one manager that is investing just in clean energy and another manager just investing in clean energy, but one's investing in the companies that do a better job at it and are figuring out a way to grow their business while the other one is not. They're both doing it for a positive impact, right? And so it's again, that's why you need to empower managers and investors with data, and hopefully, at the end of the day, just like the non-impact investing, non-ESG investing, you hope to put your money with a manager who makes better decisions. It could be better decisions for an impact, better decisions for return, or a combination thereof. And again, it's not always going to be aligned, even if you have a better manager. Sometimes that manager will be making decisions on your behalf that may sacrifice return because there could be a certain opportunity for investment that you could see that has an amazing positive impact, but just might not be giving you a return right now. But that's okay if that's what your goal for that investment is. So it's really all over the place, and but you definitely don't have to sacrifice return if you want to make a positive impact. There are positive impact investments that you don't have to sacrifice your return for.
Some of those would argue that if you ESG as a form of risk management anyway. So it really depends on how you view that as an extra layer or as a way of good governance, therefore good risk management. From my experience,
there's a difference between impact and ESG though. There is a difference between impact and ESG, right? So, ESG is not just about impact. ESG is very much a risk management tool, right? So, for example, investing in a company that has developed technology that's going to reduce pollution, or investing in a company that is building wells in foreign countries to get better access to water, right? That's more of an impact lens. ESG is correlated with positive impact, but it's not the exact same thing. And if you look at the methodologies of most ESG ratings companies and research companies, they are not measuring impact, like amount of trees planted or amount of people fed or what have you. They're trying to measure, okay, if Chipotle has better food safety procedures, will there be less E. coli breakouts and therefore less impactful for the stock price?
Okay. We've got one more question from the audience. What social, environmental, specific topics are trending with family offices? So this is something I'm going to answer that one, but then I will let the rest of the panelists do it. It's something that we monitor with a peer benchmarking to see how different family offices behave one versus another. Today, we rate that globally the social, environmental. I don't think a major shift between the two, although a major difference between the two, although environmental remains a bit of a higher priority.
Any other comments from anyone else? I do hope you guys found it interesting and insightful. It's great to see how our panelists have many different perspectives based on their experience and their background. Before we end the webinar, I'd like to let you know that we will send you some interesting content related to ESG investments, related to ESG investments in technology. So please stay tuned for future webinars where we explore some popular topics or market trends in technology, institutional investment, and family office space. We hope you've enjoyed our discussion, and we very much look forward to seeing you soon.
Thank you very much.
Thank you.
Thank you.
Thanks.